John, thank you so much for joining us today.
Well, hi, Elijah. Good to talk to you again.
All right. Now, the first topic I'd like to discuss is the stock markets globally. It seems like are in a downtrend that we haven't seen for a while. You posted about this. Did you want to share your perspective on what is happening right now? In the United States, we're seeing the Dow is hitting a low we haven't seen since July.
Well, my take on the stock markets is that it's about time. Most major equity markets got overvalued in general terms in like 2015. And ever since, you could say that we've been living on borrowed time, literally, because we've been propping up the world's stock markets and most other asset price categories by borrowing new money. The central banks of the world are creating huge amounts of new currency and dumping it out into the market, and corporations are borrowing huge amounts of money to buy back their own stock. And that's been pushing up asset prices, and it's allowed stock prices in the U.S. at least to reach levels in terms of valuation that are comparable to like 1999, 2000, which is this iconically overvalued market when we had the tech stock bubble. Well, we're kind of back there again in a lot of valuation measures. So that creates huge air pockets under the prices of a lot of these stocks. And it was inevitable that they were going to drop hard. And so we're seeing that lately with huge volatility, followed by volatility mostly to the downside, where you get 15, 20, 25% declines in a lot of these stocks. And on the one hand, it's just inevitable with prices being what they are. And on the other hand, it's potentially a systemic risk, because we are so highly leveraged in the global financial system. There are so many derivatives and there's so much debt that is premised on high asset prices going forward that you take that away. You make asset prices go down, or allow asset prices to go down to their intrinsic values, and you blow up an awful lot of bets out there. And that's what central banks are worried about. They know the numbers as well as anybody else. They want to normalize interest rates to give themselves ammunition to cut interest rates next time we have a recession. But they understand that there's a huge risk in that. Because if they raise interest rates to the point that they crack the markets, which is sort of what's happening in the U.S. right now, you don't just get a bear market in equities, you get the potential for this to metastasize across the global financial system and give us a return to 2008, 2009. We'll see how they respond to that. We can't know that at the moment, but that's really the big story out there, is what are the central banks going to do if this kind of volatility continues? Definitely,
and the idea is that they can't really raise interest rates that much more, right?
Mathematically, they can't, because it blows up everybody's budgets. If you're a government and you've got a ton of short-term debt, which is to say every government, they all have this problem. If interest rates go up and they have to roll that debt over at higher and higher rates, that means their interest costs go up. That means their budget is pushed even more out of balance, and that means people are more and more worried about the size of their deficits and what that means for the value of their currencies. You get this death spiral with interest rates going up that impacts government budgets, that impacts the currency, and so on. That's a big risk. That's a real thing that could happen if interest rates go up much from here. However, if they don't go up, you get a continuation of these debt bubbles with more and more misallocated capital, which is also a systemic risk. So they're stuck. Anything they do, something is going to.
Definitely. And what is your anticipation of what gold will do during this crash we're seeing?
Well, in 2008, stocks started to tank, the economy started to turn down, and gold plunged for like a month. And then it made a V bottom and really took off on one of the best runs it's ever had. So that's possible this time around too, where everything gets sold. People just panic out of any kind of an investment. They include gold in that and dump it, and its price goes down. then the central bank comes back in and promises to bail us out of this by printing a lot of new money, and gold takes off. So we could see that pattern again. However, gold has already had a pretty big drop. It's gone from 1900 to 1200-ish right now. And you could make the case that it's already washed out. So that when the next crisis hits, terrified capital will pour into precious metals as a safe haven, because it's the only thing that's down already. Everything else is up and headed down, and gold and silver are now down and possibly headed up. So, again, long answer. I don't know is the short answer. I think in the short run, we can't predict precious metals prices, but in the long run, it's a very, very safe prediction that they go up from here because of all the paper currency that's out there. All the fiat currency that exists in the world. If you add it all up, it dwarfs the precious metals markets right now. So if you wanted to go back to a gold standard with backing comparable to what we had in, say, 1910, which people at that time considered a great time for the global economy, you would have to, given the amount of gold that exists relative to the amount of paper, you would have to revalue gold to about $10,000 an ounce. So whether that is an explicit government decision or the market takes us there, that's the trajectory. Gold ought to go up from here on out because we have to begin the process of balancing all the increasingly worthless paper that's out there with something real to back our currencies. And historically, that's been gold. For the vast majority of semi-modern human history, we've been on a gold standard. It's only since 1971 that we completely went off of it. And that was only supposed to be temporary till we got our balance of payments issues in order under the Nixon administration in the early 70s. But as a lot of government decisions tend to be, they start out as temporary and then they become permanent when it turns out that it's nice for the politicians and their patrons to keep it permanent. So that's what we did. We went to a pure fiat currency, which is basically an unlimited credit card for the world's big governments, which they loved and they abused. And now we're finding out that abuse has some consequences that are unacceptable. So it could be that one way we get out of this is to go back to some form of a commodity-based currency, preferably gold and silver-based, that limits the amount of debt that governments can take on and limits the amount of currency creation that they can pursue. And in that way, avoids the gigantic crisis that we've got coming. We can't get out of this crisis, but once we're in the depth of it, we can debate how we prevent the next one from happening. And I think the voices calling for a return to sound money will be pretty loud at that point. They won't be the only ones. There are going to be people saying this is a failure of capitalism. Therefore, we've got to get rid of the concepts of limited government and private property and contract law and individual freedom. Those things cause this crisis. Therefore, we've got to eliminate them and create a benign dictatorship with a philosopher king in charge. So it's not clear who wins that argument, but I think that along the way, terrified capital will be flowing into precious metals regardless. So gold and silver at this point, even if they have a short, sharp drop when the economy really starts to demonstrably slow down, I think there's still the right place to be over the next decade. And that's really what our investment time frame ought to be. You can't predict what's going to happen this month, this week, this year, but you can see the broad forces that are at work and predict with some accuracy what direction they'll take the world. And it'll be a direction in which this time around fiat currencies start to fail until the concept is discredited and sound money comes back into style. And that's all great for gold.
Definitely. Now, you recently wrote an article about the short-term gold price and how it seasonally, Christmas time is very good because of a lot of buying of gold from Asia. Now, so what do you anticipate happening to gold, and also how will this impact the mining stocks? Because you put a really amazing chart about a mining stock that really rose last year during this seasonal buying.
Mm-hmm. Well, as you said, in China and India, they tend to have their weddings in the spring, and they like to give gold and silver jewelry as wedding presents because to them that's a form of money. It's a store of wealth. So they do their buying in late December and January. So that tends to put a seasonal upward pressure on gold and silver prices. So if you look at the fluctuations in gold, for instance, over the past 5 years, there's a nice spike every January. And sometimes it's sustained through the first half of the year. Sometimes it just lasts through January and then goes back down. But either way, you get a spike in January. And there's no reason to think that won't happen again this year. So you've got seasonality in your favor in the gold market, basically starting now and then continuing through probably the next few months. But at the same time, the structure of the paper market in gold and silver, that is the guys speculating with futures contracts on precious metals prices, has gotten very favorable lately too. The speculators who tend to be wildly wrong at big turning points are really pessimistic right now. They're betting that gold goes down. Since they're wrong, there's a decent chance, historically, that gold goes up just because of that. Same thing with silver. So you have these two things. The paper markets are structured very bullishly for gold and silver, and you got seasonality, which is almost always pretty good for gold and silver over the next couple of months, happening at the same time, which implies that we'll have something like 2016, which is the last time this happened, which was a really nice run for gold and silver. And, as you mentioned, a great run for a lot of these gold and silver miners that are really beaten down. Many gold and silver miners went up 50, 60, 100% in the first half of 2016. It was really surprising and breathtaking to a lot of people because they were used to these stocks just languishing, and then all of a sudden, boom, they doubled. And they're even more beaten down now than they were at the beginning of 2016. So you have the potential for a perfect storm in a positive sense for gold and silver right now, where everything works in precious metals' favor. And the miners turn out to be the best performing stocks of, let's say, the first half of 2019. I'm not predicting that, not guaranteeing it, but I'm saying the conditions are set up for that to be a very real possibility. And people with money to invest ought to be paying attention to these indicators.
All right. Well, John Rubino, thank you so much for your time today.